Thank you for joining us. Everyone, looks like today our two important changes. One is our 3 p.m. start time from our original 12 p.m. start time. So add that to your calendars. And in addition, there's going to be a new feature where we do a free stock and options pick. Jack is going to be handing that out towards the end of the show. In the meantime, today's topic, why passive investing is too expensive and where Jack's personal funds are. With that, I will let you, Jack and Norman, take it away.
All right. How you doing, Norman? You're on mute, brother. I think you're muted, Norman.
Hang on one second. Let me see if I can unmute Norman.
I just
there
all
you
it
go.
took was a simple click. Yeah, hi Jack. I just wanted to, I wanted to point to Mary just said something, asked something interesting that I think really plays into the whole dividend scheme, and the whole the way we trap, or you trap, taught me to trap income. And she says if you start over again, how would you do it? What strategy would you use to become a profitable trader? My head always goes to, especially when you're doing something new, keep the risk very low, and as you get more experience with it, you can expand from there. But I thought that what we're going to talk about today kind of fits into that. Oh, you're muted, Jack.
Yeah, just to be direct, if I had to start all over again, starting today, I would start with covered calls. No question about it.
Yeah, I think you start with covered calls because one of the things, and we were talking about this off the air yesterday, at the beginning of the week when we got together thinking about what we wanted to do with this show. That the whole risk, the whole idea of the premium pricing and how it fluctuates, and why it fluctuates. You'll be able to observe that in a very safe way by doing covered calls, because a lot of choosing the right strike price and the right length of time that you want to engage in options is going to be will be sharpened as you learn the process. I think it's important, and also what I like about that suggestion, covered calls, is that there is some skill in using the mouse. And, you really have to, for the very beginner, you really should be practicing getting in and getting out. That's whether you do that under sim or whatever. The idea of because there's only a couple of movements you're doing. You're buying the stock and then control, and then you're writing an option against it. So I think I always say the same thing to new people. Covered calls. It's funny because when I started doing options, I did covered calls. I only did that for about 5 years. And why? Because it just kept working, and it was pretty much the same stock I was dealing with in all of those years. So we may be touching on that a little today, but anyway, Jack, you've got something special today?
I do. I got a lot of stuff, but I got to leave that stock and the pick for the end, because otherwise we'll never get, unless DA doesn't mind.
No, I think hold the pick to the end, and then we can have because I know there's going to be a lot of questions about that.
Yeah. So let's go through the stuff you had lined up for today, DA. What was the first part?
So essentially, this show idea came about because of my personal question to you, Jack. You had said in a previous show that even ETFs that charge just 0.1% are way too expensive, and that made me think, well, where does Jack have the majority of his funds?
Yeah. Okay. So I have the majority of mine in income producing stocks and income producing trades. So the income producing stocks are dividend stocks that I write covered calls on and buy more of that stock, and you can reinvest the dividend. And the other one is I use stocks like Meta, Google, AVGO. I use stocks like that to create income trades. and then probably 5% to 10% is in speculative trades, where I'm just maybe buying a stock or something like that, or an option. So most of it is, 80-90% of it is in the stuff that makes me income, because that's, to me, where the money's at. And that's easier to trade like that, and it has less risk. And then I just got the small percentage of stuff when I'm playing around.
Yeah, you don't want to put yourself in a hole when you're, especially you're beginning, because we all know, anybody that's traded for a long time, that it's the emotional part that will kill you in trading. And when you can repeat the same motion each time, where it becomes almost habit, there is safety in that, and it's also safety between the ears. Then it just becomes really a matter of position sizing. How much do you want to take on? And I do want to note that you just said 5 or 10% speculative, and I think that's really the right combination of somebody's total assets. When I do talks on managing risk, I always talk about managing risk in a particular position when you're in the one you're trading right now, and then managing your risk on the whole, because you're looking at one part of it. And so there are several layers to managing risk. And if you can keep the speculative part under control, you'll have a portfolio that will just grow. And we were talking about, Jack, that I find that when I coach traders on the emotional side, they don't really have the respect for the leverage that the options can give them, and they're always looking a little bit too far out for what they need to be looking at. Those small increments, those small steps, really do add up. And if you're in the right positioning, sometimes you can get a big hit on the positive side while you're being conservative. So there's enough in option play to to satisfy pretty much everybody if they can just stay under control.
Yeah, and I think there's just so much less risk in the income trades as well. It's very difficult to make a directional trade in this market, but there's a few out there that I do like all the time, and I'll give you one here before we leave.
For all those out there, directional picks mean betting on something either going up or going down. Jack prefers something where almost either way you go, you're going to benefit. And if you're doing it on a stock that has, if you're owning a stock that has dividends, you're just going to get that one anyway.
Yeah.
So it's a kind of double trouble.
Double trouble. And people say, the question I got here from DA also is, if income trading is so great, why don't more people do this? And I told them that I don't think people know it or understand it or even expect it from the stock market, because when you think about the stock market, you think about just buying a stock that you think is going to go up. There's no consideration for how would you use options to create income off that stock. So maybe it's an advanced thing. And I think also it's just after you've traded for a while, everyone's trading style is just a reflection of their personality. And for me, I just don't like losing money. I've done enough of that. And the income thing is just, it suits my personality better.
Yeah, I think, and that plays into your being comfortable with the outcome. It's very interesting. Christopher Allen just posted a question. Says, do you find that with many of the better dividend paying stocks that the covered call premiums are very low, that the beta is low on them?
Yeah, it is. And that's a problem for the covered calls. So, one that has a better beta would be Devon, DVN. But for the most part, you're right. The better dividend paying stocks have not good covered calls because they have a low beta. They're not volatile. And if they're not volatile, there won't be any high premium in the option to sell. For example, AT&T, terrible options. Ford, terrible options. Realty Income Corp pays a monthly dividend, terrible options. So that is true. I do find that the better dividend paying stocks, that the covered call premiums are very low. So, in my portfolio, I sell calls against Johnson & Johnson, J&J, AbbVie, IBM, McDonald's, Coke, Morgan Stanley, lot of different stocks. And I just take what I can get. I look for a call 30 to 40 days out so that I could do it every month, preferably. And then I just take what I can get at that price, 7 to 10% higher than what the market's at the time I sell the call.
Let's dig into a little bit why you have 90% of your investing in income plays as opposed to something more speculative. I mean, what goes through your head, especially when you had an opportunity, or you saw something that was that could explode, and you chose to not to take advantage of that in a more speculative way, and it could have been a big winner. What do you say to yourself? Because people say, I should have had that. I wish I should have. I just think that's that's so common. I wanted to hear your take on it.
Got that 5 to 10% dry powder that I could use. And I have no problem with missing out on stuff. But the biggest thing that I do that's different from other people is when I log into my account, I don't look at the P&L, right? That's how every single person in the world, even the default platform, is set up to just go right to your positions in your P&L. I like to look at the investment income, meaning how much cash flow is this account throwing off every month? That to me is the single most important thing. That's for me, that's where it's at. So I'm focused on building that up, constantly building that up.
Yeah, and I think that I'm just gonna get a little way out here. The word gratitude comes to my mind. I think that every time I take a small profit or a large profit, I'm very grateful for it. I used to whisper things to myself. I've stopped doing that because I was always put away. But and I think that when I take some of a move and I'm not involved in the rest of what could have been for me, I always feel like I'm grateful for to give that opportunity to somebody else. In other words, I don't have to have all of it. I don't need every penny from every move. So there's a lot to do with just being grateful that that we have the opportunity to be trading like this, especially in a safe way, especially in the way that you talk about, Jack, which is really why I wanted to come on this show right from the beginning, because you're odd. You're odd in a few ways, but you're odd in the way that you've stuck to this. 90% of what you do is the very conservative stuff. Most people that enter a leverage arena, they want a little bit more. But what it winds up is that they're going like this with their equity. I mean, it may go up, but this is not an easy road to follow. This is a much easier road to follow, and so and I respect that about you. But I did want to know what you felt about that. So
yeah, TC brings up a good question. The first thing he says is, do you have stocks that would be good for low money startup at this time? And the only one I can think of is ticker symbol PLTR. I own the stock. I'm not recommending you own the stock, but it's got a wicked wild beta of about 2, and the stock trades around 15, 16 bucks. So you could get, if it's at 15 bucks, you could get 100 shares for $1,500, or you could, if you used margin, you could get into that trade for $750. Then you could pick a call 7 to 10% higher than the price you paid for it, and pick an expiration like 30 to 40 days out, and you lower your cost basis by the amount of the premium you brought in, and you just do it every month. And then the other thing he says, which is the exact same thing little Jack said to me the other day, TC says,
is that in your mind, little Jack, or is it
no, I got a real little Jack.
Okay, good.
It's not a figment of my imagination.
It's not a fig Newton of your imagination.
Not in a fig Newton. So I showed him a stock. TC's question is, how do you know the stock is going to move within a month? And little Jack's question basically I showed him a stock that was trending higher, looking at a chart. I said, this one's going to go up. And he says, how do you know? Like real sarcastically. And the answer is, I don't know. I have a probability based on my experience, look at pattern recognition, looking at that trend. I'm pretty sure, best I can be as sure, but I don't know. No one ever knows. So you just got to take that risk. So that's what you're taking. You don't know that the stock is going to make a move in a month. But here's the thing: if you buy a stock for it to make that move, it's got to make that move. If you used, for example, a credit spread, that stock could just stay at the same price for the whole week or the month, and you could still make a great income trade off that.
I think somebody's backing up bad Jack and good Jack. Somebody says
bad Jack and good Jack. No, he's probably the good Jack. Yeah, you need 100 shares of a stock, Sandy, to do a covered call. So like PLTR, if you're looking for a low price stock, Devon Energy is one I like. That's like $50. So you get into that for like $5,100 or $2,600 if you're doing it on margin. And again, that's got some fat premium. That stock's kind of volatile, pays a whopping dividend too. Real whale of a.
So what's your definition, just for those that maybe not have seen past shows, what's your definition of the right stock to be writing options on?
Yeah, the right stock, it has to have two things going for it. It has to have a directional bias, which should be up, and it has to have some volatility. It has to have a beta greater than 1. So beta of 1 means the broad market has a beta of 1. And if an individual stock has a beta of 1, then it's just as volatile as the broad market. If it has a beta over 1, it's a little more volatile than the broad market, and therefore it'd have higher premiums in its options for you to sell. And I do hold the option when I'm doing a covered call, Sandy, until its expiration date, because I expect it to expire worthless. So I like to sell it while it has some time value in it. And in a month later, it just expires worthless and they journal it off your account. You keep all the money.
Well, I mean, again, I tend to, for a long time, I tend to just kind of grab it when it gets very low, offset the option, and not expose myself to the risk of the last few hours, the last couple of days. But you like to get it all, and I
like to get it all. Well, sometimes on a covered call, I like to get it all, but on a credit spread, if I'm in a real volatile stock and the strike price I have is out of the money, but not out of the money by much, I'm going to close that out, because the options exchange has until 11:59 Saturday night to assign the stock to you. So if something bad happened in the after the hours of the market, then there'd be a risk that I would be assigned that stock. And when I do credit spreads, I don't necessarily want to own the stock, but when I have a covered call, I already own the stock. So I'm looking for that to expire worthless, but I don't necessarily want to be assigned a stock that I'm doing a credit spread
on. Somebody, TC, has a 3-word question. Explain a covered spread.
A covered call is one thing, and a credit spread is another.
I think he misheard you there. So that's a credit
strategies, which is normal. So a covered call is when you own 100 shares of stock and you sell a call option against that position. A credit spread is when you sell an option and you buy a lower strike price option to create a net credit. And I'm going to give you examples of both of those in the real trade I'm going to give for you.
Hey, Jack, I'm going to jump in one quick second, because yesterday during our planning meeting, you were very excited. You said, don't let me forget this. Why ETFs are bad for credit spreads.
Yeah, we got to talk about that.
Yeah, well, everybody strap yourself in, everybody.
ETFs are terrible all the way around. The only thing I can think of worse than an ETF is a mutual fund, which if you have any of those, just get rid of them. The fees are outrageous. They're diluted. They're over-diversified. It's a nasty problem. ETFs are not that much better. They still charge anywhere from around 0.8% is a fee taken out of that ETF price. And you think that's low, but when you add up how much money there is invested in that ETF, the billions and billions and billions, the ETF issuer is making a fortune off that. And I don't think you need to pay anybody anything to do a trade or buy an ETF. I think you can get the same stocks that are in an ETF for free. And you don't want every stock that's in an ETF because most of them are over diversified like a mutual fund. And the way you can tell that is they're not volatile. Their betas are so low, they're not worth doing credit spreads on. And the other problem with them is you have to get too close to the price of the ETF when you're doing the credit spread. Whereas on a stock like AVGO or Meta, you can get way further down out of the money and make more money with it. That ETF, you got to get real close. Sometimes you got to place that credit spread inside the normal trading range of the ETF, and that'd be a situation where you probably get stopped out. Wash sale, that's that's a pain in the ass. I got that going on. That's when you sell a stock and then you buy it back within 30 days. That's an accounting issue, Karen. Yeah, you want to talk to your CPA about that.
And you want to be careful.
CPA, get a CPA and get an LLC and put your brokerage account in the LLC, and you can deduct everything from it, run it like a business.
There's a long one there, Jack. I have a stock.
Yeah.
I have a stock.
Got a stock. He sold a covered call, and the stock is in the money, which means they're going to take it out of his account. Would you buy the call back or let the stock get assigned? That's like the number one question. So let's just recap that. Will's got a stock. The stock went, and Will got a stock, and he sold a covered call at a strike price he picked. Now the stock price is higher than that strike price. That means he's going to have that stock called away from him. The question is, would you buy the call back or let the stock get assigned? This is a no-brainer. If I would never buy the call back, if the price was higher than my cost basis, I would just let myself get assigned and buy the stock back the following Monday. Mm-hmm. If I were to get called out a strike price that was below my cost basis, because I've been doing it for a while and the stock went down, then I would buy the call back because I don't want to get called out at a strike price below my cost basis. Right. But normally, if you bought a stock and you sold a covered call and the stock price went above your strike price, that means that you made money on selling a call premium, and now you're going to make the difference between the price you get called out of the stock at, that strike price, and your cost basis. That's usually a big profit. Right. So I like getting called out. I don't want to buy the call back just to avoid getting assigned.
Let's see, no wash, we get that.
Yeah, Karen, do that. Get a CPA. The other thing about a CPA is if you ever get in trouble with the IRS, you blame it on them. They're the ones that got to show up in court, not you. So
that's
how you got that going for you.
Years ago, I've wrestled with the IRS before, and it's not an easy wrestling match. You got to have everything in the right place. There's a hedging question. How are you hedging or protecting your portfolio from large drawdowns?
This is a great question, Colby. Yeah. I'm going to give you the super tip of the day. Like, let's say you own NVIDIA or you buy NVIDIA. Let's say you buy NVIDIA, and where's NVIDIA at right now? I don't even know. 260. The single best way to hedge and protect yourself was, now you bought NVIDIA, let's say it's at 460. The best way to protect that position is to buy a 460 strike price put option that's going to expire in about 30 to 40 days. That way you bought the right to put NVIDIA to somebody at 460, which is the same price you paid for it. That's a married put, if you want to research that. That's awesome. We had a whole class on that. I should dig that back up. The more volatility increases in the market, the more you want to apply that married put. But I don't do the married put on like JNJ and AbbVie because they're not that volatile. But you can get, especially before earnings, when earnings is coming up on a volatile stock you own, consider just for insurance buying a put. That way even if you don't have 100 shares, that put controls 100 shares. So if the stock goes down, that thing's going to soar in value and offset any loss you had on the individual stock.
And the difference between GOOG and GOOGL?
The L's have voting rights.
Yeah,
Which I don't care about that. I don't even have, I got adult ADD. I can't read a prospectus on a voting issue,
I used to get those all the time. They're like this,
things, man. I can't read it. It's written by weirdos.
It's a preferred, yeah. What is it? There's a so-called preferred stock, the GOOL.
Yeah. I don't have any preferred, but Dan, I own more treasuries than I've ever owned in my life.
Well, at this rate.
Yeah. It's unbelievable. The last one, I think the last 8 week or 13 week or 17 week went out at over 5.3% in the auction. Like and you can roll those over automatically through Schwab and Fidelity, and even at treasurydirect.gov, I think it is. You can buy them right there. Yeah. I'm not playing them. I buy the 4 week, 8 week, and 13 week and 17 week. I got equal amounts in 4, and then they automatically, as soon as they mature, they reinvest it for me. Yeah, TC, we'd have a whole issue on. It's like buying a CD at Treasury. The only difference is the federal government is the one paying the interest on it and not a bank.
Right.
So yeah, it's the Treasury. Just so you guys know, that's considered the risk-free rate of money, and it's also the lowest risk. Yeah, like I say,
lowest yield, right?
Yeah.
Let's see.
Hey, Norman, while you see if there's any other questions, I'm just going to jump in. Jack, we got about 3 minutes.
Time to drop.
Yeah, time to drop the thing. Maybe there.
Yeah, I think we've covered pretty much all the questions, but go ahead, Jack. I think everybody's waiting for this.
Yeah, everybody's waiting for this. Okay, here we go. Meta is the stock, META. I own it. Full disclosure, I'm not telling you to buy it. I'm just saying that I own it. Now, here's 2 trades for you. I'll give you a debit spread, and I'm going to give you a credit spread. Okay. Now, this is a debit spread that is only going to work if the stock goes higher. The credit spread is going to work even if the stock doesn't move. You take your pick based on your personality. So for Meta going up, we're bullish on the stock. Instead of just buying a call, which is normally 100% of the time what people do, we're going to do a debit spread. And the difference is we're going to buy a call just like regular people do. We're going to buy the Meta October 20th, 325 call for $670. That was a price. I looked at it before we started the show. The Meta October 20th expiration, 325 strike price, call for $670 was the price. At the exact same time, simultaneously, we're going to sell the Meta 350 call at $1.79. That's going to mean we can get into the entire trade for $492 per contract instead of $670 per contract. That's a debit spread. Okay. It's cheaper than buying a call, but it's going to cap our rate of return is going to drop significantly if Meta gets over 350. But hey, that's fine.
Safer bet. I'd rather get a safe short money than risky long money.
You're capping your profits, but you're getting to the trade for very cheap. That's a debit spread. You're buying one call for $670, the 325, and you're selling a higher strike price call, the 350 for $1.79. Net, you're into the trade on this example, $492. Now the stock's got to go up, or that $492 is going to disappear by October 20th. All of it. All right. Now the other side of the trade, we're going to do a credit spread. That was a debit spread, credit spread. Here we go. Now we're going to use the same expiration, October 20th, and the stock is Meta's at 310, right? Now we're going to sell the Meta 280 put. We're using puts here because I don't think Meta's going to go down to 280 by October 20th. We're going to get 248 for that. Then to protect our downside, we're going to buy the same amount of contracts. We're going to buy the 275 put. That's $5 lower than the 280 put. And we're going to buy that for $1.58. So our net credit, we're always going to get more for the put we sell than we spend on the put we buy.
Credit's about
get 248 for selling. We're going to spend $1.58. We're going to have a net credit of 60 cents. Now, how much money is that? Well, that's $60 per contract. But what it really is if you take 60 cents divided by 5, which is the difference in strike prices, that's a 12% return on October 20th. So you got a debit spread, which there's a question mark. What is the outcome of that? Well, we don't know. It's either going to work great or it's going to expire and you're going to lose 100% of your money. Now, if Meta doesn't go up, you're going to lose all your money in that debit spread. But if Meta just stayed at 310, you're still going to make 12% with your credit spread. So knock yourself out, folks.
Beautiful, yeah. And you have delivered.
Hey, Jack, I just dropped just for you and Norman. Take a look at that debit spread I wrote out. Can you please confirm that's right? I don't want to throw it in the main chat until you confirm it.
Yeah.
And then once you do, I'll write this credit spread in there.
Yeah, the first one, right?
Yeah, put the credit spread in there. Yeah, that's good. Yeah, so Meta in the debit spread, Meta has to go up. And that's fine because it's already trending higher. That's why I would consider this for a debit spread. But me, I'd rather just take this stock and use it as an asset to create income. So I'll take the 12% and it can go to 600 and I don't care, right?
Mm-hmm.
There you go, Bubby.
That's very nice. Very nice, you know.
I know I laid that out on you pretty fast, but you know.
All right, folks, here comes the debit spread first. And next up is the credit spread. If you have any questions, go ahead and drop them in the channel because, it looks like we're 2 minutes over, but stick around just for a minute or two, Jack and Norman, in case there are questions. Yeah. The debit spread and the credit spread are now in the chat.
One of my all-time favorite traders is a guy named Tony Saliba, and he's in the book True Market Wizards. If you can even get that book anymore, it's impossible to get. But that cat is one wild dude. And his second favorite strategy is the debit spread. And what he does is he just loves them. He'll buy, 3 or 30 or lots that he can get 3 trades out of. So once the thing goes up like 50%, he'll sell one of his 3 lots. Then when it goes up another whatever percent, he'll sell another lot. Then when it goes up even more or not, he just keeps that third piece out there, that third contract to shoot for the moon. So he loves debit spreads. And that's exactly, they like to pick them 3 months out. I think that's too far out. You pay too much.
Yeah.
For this, I just think we keep a shorter horizon and a shorter view. And it's just an idea. It's just an example of a trade. I'm stay spread and stay safe. That's what Saliba says, Dan. That's funny.
Yeah, I got that too. 90. Somebody mentioned, isn't the net credit on the credit spread 90 cents, not 70 cents?
Yeah.
So you had said 70 cents, and I had 90, and he had 90.
Yeah.
So yeah.
Where I did it wrong. Yeah,
that's okay.
So anyway, you take 90 divided by 5. What's that give you? A whopping yield.
Yeah. Thanks, very helpful. Spreads, Meta, I was nervous about the higher strikes in the.
No. What I do, these are just examples of a debit spread and a credit spread in the same time frame. But I use Meta on a weekly basis.
Mm-hmm. Well, there's a correction on the credit spread there that was just posted in the chat. So
90. So 90 divided by 5 is what yield? 18%, Al says. Mm-hmm. That's not a bad sandwich.
No.
And listen, I'm just going to jump in here. As an amateur, what I've been doing is paper trading. I'm on Thinkorswim. I will open up the paper trading portion of Thinkorswim and take these plays that Jack puts out there because, I don't want to risk real money on it, not because I don't trust Jack, but because I don't trust myself. I might click a wrong button. I think I did that the other day. I hit some wrong thing, and if it was real money, it would have been mess up. But now I get to learn the mechanics of how to do it. Once I get familiar with the mechanics of it, then I can get into this with real money. So that's just a suggestion from me.
Yeah, I hit the wrong button quite a bit too. Yeah.
Russ is saying that it's now 0.59 and not 0.90 anymore. But this is what you have to pay attention to. That's
just
why
an
the
example
focus.
of a trade. It's no recommendation or anything like that. So if it changes, it changes. I can't control the stock prices, but it is what it is. And it's a learning example. You can paper trade these, see how they work out, and then repeat the process. Our October 20th is our expiration date there, Dave. Good.
Okay, well, if we're out of questions, I got called away in the beginning. How can I listen to oh, I see. When you say called away, don't say it like that, because I thought you just lost some stock. Maybe it's because I'm wearing my special T-shirt today.
Just trade.
So,
Bob, to answer your question, for recordings, I'm going to drop a link in the chat here. I'm going to put for weekly spread recordings, and then I'm dropping a link there. Right now, obviously, this show is still live, so you won't see anything. But
save these questions, Donna, for next week. And Dinosaur, everybody who's got a question, save it for next week. They're going to kick me out of the Son and Elp Hotel.
where are you? It looks like the Library of Congress. Where are you?
Yeah, I'm in Vail at the Son and Elp Hotel. I'm in the library.
I see.
I'm supposed to keep it quiet. And I'm making all kind of racket, playing AC/DC and shit like that.
Yeah. Box tops, that'll kill us. Man.
Thank you, folks. Jack, Norman, an action-packed show. I'm going to go ahead and recap. You guys feel free to sign off, and we will see you back here next week.
Soon. Thanks, everybody.
Talk to you soon.
All right, folks, thank you for coming to today's show. There's a lot. I'm not sure I got everything, but I'm going to try to recap what I took notes on. First question we had started the show, kicked off with, if you had to start over, what strategy would you do? And Jack answered that without missing a beat, covered calls without a doubt. The majority of Jack's funds are in income trades, spreads, selling covered calls, selling naked puts. And that includes, a lot of people think, oh, he's just doing that with some side money, that, he's got his main retirement funds or personal funds in passive investments, and that's not true. Jack later went on to recap why he thinks ETFs and passive investing are too expensive, even if they only charge you 1/10 of 1%. Someone then came in with a question: are the better dividend-paying stocks not having good covered calls? Do they have low premiums? And Jack said yes, that is true. They're not volatile enough, and so the prices on options as a seller are not going to be good. He did give DVN, that's Delta Victor Nancy, as a good dividend-paying stock that has good options for sellers. He said it's because it's volatile enough. Later on, he went on to explain that good volatility, what that means is a beta of greater than 1. A beta of 1 is what the market is. So the market is always a beta of 1. And so you're looking for stocks that have a beta greater than 1 or have volatility greater than that of the broad market. Those are going to make for good income plays. One golden quote, I thought this was fantastic when Jack said it: after a certain number of years, people's personality is reflected in their trading style. So if you're a risk taker, you're going to go for speculative plays. If you are more conservative, if you're more concerned with preserving capital, you are probably going to be drawn to income trades. And it's just a reflection of speculative plays being more like gambling. You're putting money out there and you're hoping that the stock goes up. Whereas with income, it's more consistent. The wins may be smaller, but they are a lot more consistent. And in a past show, Jack and Norman have both reiterated to us, this is what makes people rich. Bill Gates and Warren Buffett are not out there gambling that XYZ is going to go up. They're doing income plays. Let's see here. Oh, what Jack is selling covered calls against. He recommended specific stocks. I've got 4 tickers: JNJ, ABBV, AbbVie, I believe that's a pharmaceutical, IBM, and McDonald's, MCD. He also said Coke, which I don't have the ticker for. I believe it's K, but I could be wrong on that. And Morgan Stanley, I don't have the ticker for that. If anybody wants to look it up. Total of 6 companies, but I only have 4 actual tickers. You'll have to look up the 2 for Coke and Morgan Stanley. And then what he does when he sells covered calls, he says he looks for options that are 30 to 40 days out. KO. All right. Thank you guys for the ticker on Coke and Morgan Stanley MS. Perfect. Thank you guys. What he does when he sells covered calls is look for an option that's 30 to 40 days out. So he can do this once a month or roughly once a month, and 7 to 10% above the current stock price. So he's got room where he's not necessarily going to be called out, or at least he reduces his chances of being called out. And let's see, somewhere I'm going to try to skip down a little bit because somebody brought up a really good point about that, about being called out. Somebody had a question. I have a stock. I'm going to be called out. I forgot if it was this Friday or next Friday, but I'll be called out soon. Should I let it happen or should I buy back the call? And Jack said it was a very easy question to answer. Hold on, trying to find. I lost my place in my notes here. Okay, very easy question to answer. If the strike is below your cost basis, if the strike is below your cost basis, you're going to want to buy it back because you don't want to be called out at a loss. If the strike is above your cost basis, you will let it get called away because it's profit. Whether it's the full profit you could have gotten or they're getting a better deal on it, doesn't matter. You've got a profit, and then just buy. The next Monday, open up a new covered call against that. And that's what he does. It's just a repeating process. Buy the stock, sell the covered calls several times or many times until it gets called away. Once it gets called away, you know that you've made a massive profit on it, and then repeat. Buy the stock again the following Monday and start selling calls against it. Norman talked about gratitude when he said, when I take some part of a move, I feel grateful for the part I got. I don't need to be involved in these huge moves and squeeze every penny out of it. A roller coaster is not a very easy road to follow. The smooth upward curve is, and that again taps into what they said before. When the wealthy are tapping into income plays and not into speculative plays, which has, that roller coaster going up and down. I got a huge win. Oh, I got a huge loss. Huge win, huge loss. I mean, that'll give you whiplash. Pardon me. Someone asked, do you have a stock that would be good for low money startup right now? Jack, without hesitation, and he has said this in previous shows as well, so I know that this is something he goes back to time and again. PLTR, I believe that's Palantir. Jack owns this. As with all of his recommendations, he says he's not recommending you buy it. Do your own research. Make sure you understand it before you just buy it straight out. But he says the stock trades for $15 to $16, so you can get 100 shares for $1,500 to $1,600, or $750 to $800 if you're doing it on margin. And again, repeating what we said before, just pick a call 7 to 10% out of the money, 30 to 40 days out, and repeat that every month. At some point, it just becomes mechanical. How do you know? Oh, his little Jack, his grandson asked him, how do you know if a stock is going to move within a month? He showed him a trending stock chart, and he very sarcastically, little Jack asked, how do you know that? Very sarcastically. So Jack said, well, look, it's probability. It may happen. It's very likely to happen. It's a matter of pattern recognition, of following the trend. No one is sure that stock is going to go up, but if it's been going up, chances are it's going to continue going up. And if you play the odds, then chances are you're going to win. If you buy into, on the other hand, if you buy into that stock, hoping that it makes that move, you need that stock to move in order to get anything from it. But when you do it as an income play, whether it goes up or stays flat or even slightly declines, you are going to be safe. Someone asked, what are the criteria you have for the right kind of stock to sell options on? Jack mentioned 2 things: a directional bias, which should be up, and the beta or the volatility greater than 1. Again, repeating what we said before, the broad market has a volatility of 1, and you need something more volatile than the broad market. Let's see. Someone else asked, do you hold until it's expires worthless, or do you buy it back? Jack says, I hold the option until it expires worthless because I want it to expire worthless. When you're an option seller, you keep all the money, as opposed to the flip side, when you're an options buyer and something expires worthless, you lose all your money. On the flip side of that transaction, when you become a seller, someone is keeping that money, and if you're the seller, that's you. John Strong, thank you. Palantir 1580 right now, right in that range Jack was talking about. Ken B is asking, does he hold over earnings? I don't know to answer that question, but I do know that Jack, let's see if I can find it in my notes here. You can use a technique called a married put. If earnings are coming up on a stock that you have, you can put a married put on it. So essentially, if you own NVIDIA at 650, you can buy a put at if you own NVIDIA at 460, you can buy a married put at 460, and that will act as your insurance. That's about all I know. I don't know about the married put. So if you have further questions on that, bring them to next week's show. Sure to be a great one, just like this one was. Let's see. And I guess that was about it for the notes I have. The final thing I have are the 2 picks that Jack gave out. I'm going to go ahead and drop those in the chat again. Give me just a moment to get it together here. Today's picks. All right, remember the debit spread. The debit spread only works if the stock goes higher. Dropping that in the chat right now. And whoops. The credit spread works even if the stock doesn't move. Now, someone did chime into the chat before and said that the net credit that Jack talked about has gone down to 0.59. That's always going to be changing minute to minute. So just beware, take note before you do anything. And as I recommended, I would paper trade these until you get familiar with it, specifically the mechanics of it. It's very easy to hit a wrong button and have in your head the right thing to do, but actually click the wrong button and do the wrong thing. So paper trading, I think, is golden. I highly recommend that to anybody. And that's it, folks. I did see one more check, one more question here in the chat. Was the ticker Jack had ABBV? He mentioned that. Let me see if I can find it in the notes here. ABBV. That was in the list of stocks that Jack sells covered calls against. J&J, ABBV, IBM, MCD, Coke, which someone said is KO. Haven't verified that myself. And Morgan Stanley, someone else said is MS. Question here, what does he mean called away on the covered call? So when you sell a covered call, you're selling someone the right to call away or take from you a stock at a specific price. If a stock is trading at $100 now and you sell a $110 covered call, someone has the right to call that stock away from you at 110 if the stock price goes above 110. So if the stock goes up to 109 and then the expiration date of that option comes, nothing happens. You keep all the money for that right that you sold them, and they get nothing. That's when an option expires worthless for the seller, and on the buyer side, you keep the cash. Now, if that stock goes to 111 or 115 or 130, whatever it may go to, then that's when you get called away. You are obligated, because you got cash for selling that right. You're obligated to give that person that stock for 110, even if it's trading now for 111 or 120 or $200. So that is what Jack means by being called away. Let's see, anything else? Earl was asking, what date are we using? I believe those picks that Jack said was October 20th. October 20th on all those picks. All right. Great show today, folks. Very long. Wow, we almost went an entire hour. Please remember our new time is 3 p.m. Eastern. 12 didn't seem to be working for a lot of people. So we're changing to 3 p.m. Eastern, still on Thursdays. And we will see you again next week. Thank you so much. Great. Yeah, great to see the feedback. Thank you. Great session. Thank you. Fantastic. All right, folks, signing off, and enjoy your weekend. See you next week.